Hi everyone. In today's video, we will look at what is MTD, who does that apply to, and what MTD record keeping do you need. Now first, who does that MTD apply to? Now MTD will apply to anyone who has got gross income of more than £50,000 if he is self-employed and if he has got a property income. That means if your combined gross income is more than £50,000, for example, your sales from sole trader were £30,000 and you're receiving rent of £20,000, that brings you under MTD regulations. So you will have to file 4 returns every year plus your annual declaration. This threshold of £50,000 is for the current year 24-25 that you are filing. If between 25-26 your turnover is more than £30,000, combined gross income is more than £30,000, then you'll have to do it 4 times a year from next year, and following year the gross income threshold is £20,000. Now we look at the MTD record keeping and what does this MTD relate to, who is in and who is out. If you're still keeping paper receipts in a drawer, a shoebox or a file, well, you may need to change this habit because it can cost real money in 25-26. Because under the new MTD HMRC rules, HMRC expect digital record keeping, not the pile of papers. The issue is, remember, paper receipts are not banned. You can still use them, but relying on them creates risk. You may lose it. They may fade over time, and more importantly, they are not part of the digital system. And under MTD, your records need to be complete, accurate, and regularly updated in a software. Now, issue is, many people collect receipts, but they do not process them. They plan to deal with them, call it at the year end. But under MTD, that delay means your submissions throughout the year are incomplete. Another problem can be manual entries. If you're typing receipts into a spreadsheet later, there can be errors, wrong amounts, wrong dates, wrong categories, and those errors may be repeated over time, quarterly and annually. So if your expenses are not recorded digitally, it is very easy for it to be missed on quarterly basis. And if it is missed, you could end up overpaying tax, which is yet another cost for you. Remember, it's not just the penalties, but the interest that HMRC can also charge you. For example, a sole trader, he spends $2,000 on allowable expenses but loses some of his receipts and forgets to record other digitally. Those expenses never made it to his tax returns. That means he'll end up paying extra taxes. He'll have more profit. More profit means more tax. In order to avoid these errors or mistakes, the smarter approach is simple. Capture receipts as you go. Use apps that can scan and store them digitally for you. Link them to your transactions with your bank and keep records updated regularly. Finally, paper receipts are not the problem, but ignoring digital record and keeping them is the problem. Because from this year, the cost of poor records is not just admin stress, it's also tax and penalties. It's paying more tax than you actually need to and risking compliance inquiries at the same time. Thank you.